Hi traders, you're welcome back to the Forex Geek channel. In this video, we are going to talk about event-driven trading. Now, markets move for a reason, and event-driven trading is all about capitalizing on those moves. Yeah, economic data, central bank meetings, earnings reports, geopolitical events, and all of that. They all create high impact trading opportunities, right? But here's the question: how do you trade them effectively? So, in this video, I'm just going to break down what event driven trading is and why it is so powerful. I'm also going to be talking about how to anticipate and react to key market events and how to manage risk and volatility effectively. So if you want to trade like the pros, smash that like button and subscribe for more expert trading strategies. Now let us start with the basics. Let us start with the basics. What exactly is event driven trading? Event driven trading is a strategy that focuses on major financial events that impact price movements. All right. Instead of relying solely on technical analysis, traders use economic reports, breaking news, and key announcements to anticipate market direction. Right. So I'm just opening the Forex factory calendar where we can look at a couple of major events that usually impact uh trade direction. Let's just focus on the high impact news. Okay. Now, these key events that we are talking about, um they include economic data releases, such as the non-farm payrolls, um, CPI inflation, GDP reports, you know, and then we have central bank announcements, also like, Federal Reserve interest rate decisions, the ECB press conferences, and then we have earnings reports, which are quarterly financial reports from major companies, and then we have geopolitical events such as wars, political shifts, trade agreements, and so on. Now, each of these can create massive volatility in forex, stocks, and commodities, making them prime opportunities for traders who know how to react. So now, how do you trade key market events? The first step is to identify key market events. Successful event-driven traders plan ahead. That means keeping track of major upcoming events using an economic calendar like the one that is right here on the screen. Okay, this is a popular economic calendar, the Forex Factory. So some of the biggest market moving events include the non-farm payrolls, the NFP, which is released on the first Friday of every month. This US jobs report causes huge volatility in forex markets. Then we also have inflation data like there's the CPI, and the PPI. Okay, we have the CPI and the PPI, right? Inflation numbers impact central bank policies and can drive strong market trends. Okay, and we also have interest rate decisions. The Federal Reserve, the ECB, and other central banks dictate monetary policy, causing shifts in currency and stock markets. And then finally, we have the earnings report. A strong or weak earnings report can cause a company's stock to skyrocket or plummet in minutes. So always check the market consensus before an event. If expectations are too high, or too low, price movements can be extreme. Okay, then the next step is to analyze market expectations versus reality. Markets don't just react to news, all right? They react to how the news compares to expectations. For example, this is the NFP, right? We can see that we have forecast. We usually have forecast, the forecasted number of jobs that are going to be added, non-farm jobs, right? And then after the news has been released, we are now going to get we then get the actual value. For example, the last NFP release that took place was on March 7th, right? And the forecasted number of jobs was 159,000, but it happened that only 151,000 jobs were added. Because of that, it negatively affected the USD because the expected number was 159,000, but the values, or rather the figures, came out lesser than expected. Okay, so as 159 was expected, but only 151,000 were reported, the market reacted negatively for the USD. So this is where trading opportunities arise. If the actual data happens to be better, prices tend to rally. It's going to be stronger for the USD had it been this actual data was more than 159,000. But if the data disappoints, then you expect sell-offs. Okay, so this is why it's important to follow analysts' predictions and compare them to the actual outcome. All right, now the third step is to react quickly to price movements. Once the event happens, traders must act fast. So here's what to watch for. Let us, like I said, this happened on March 7th, right? Let's just see if we can find the activity of the USD on that March 7th. Let's see, around the time when the jobs reports were released. Okay, this should be the date. Let's just look at if this is a very practical example now. All right. Okay. So around the time that the job report was released, I think it should be somewhere around here because I can see volatility, the way this spike happened and all. I think this was probably 1530, and if we come back here, we can see 130. Okay, it's just a difference in time zones. Now I think this was when the job release took place, and you can see that on the 1 minute time frame you're going to see something interesting. You're going to see something interesting on the 1 minute time frame. So can you see, as at the time when the jobs report were released, can you see on the 1 minute time frame, you can see this significant volatility. You can see this activity here that was a result of the jobs report. So whenever jobs report, or whenever such news comes out, you have to react quickly to price movements, because once the events happen, traders have to act fast. So you should be watching out for breakout. For example, you see this was a resistance zone. Can you see? But the job reports resulted in a breakout. Now we can see that this was even kind of a phase of consolidation. There was a period of consolidation around here, and then can you see that we had a breakout to the upside? So if price breaks a key level after an event, it may continue trending in that direction. Then we also have whipsaws. Whipsaws usually happen also. Volatility can cause quick spikes and reversals. Exactly what we had here. You can see this whipsaw that happened right here before the market picks a true direction. And then ensure you always get confirmation. Wait for price action signals like strong momentum candles before entering a trade. Okay, for scalpers and day traders, event driven trading provides some of the most explosive opportunities, right? With big market moves come big risks. So here's how to protect yourself when trading events. The first step is to use tight stop losses. Since event driven trading can be volatile, Stop loss orders are essential. Placing stops too far away can expose you to unnecessary risk, while stops that are too tight may get triggered by short-term noise. So a good rule of thumb: place stops just beyond key support and resistance levels. All right. Now, the second step is trade with proper position sizing. Volatility can be unpredictable, so adjust your position size to account for bigger price swings. Okay. Reduce your trade size during major news events to avoid excessive exposure. And finally, avoid over trading. Not every event is worth trading. All right. So you can just pick high impact events with strong pick high. That is the reason why you can see in this filter I had to deselect other folder. Right, this red folder is usually representing high impact news, so I just left only the folder for the high impact news, because that's the only news I'm interested in. Right, so you can see that these red folders represent high impact news. They're the ones that usually affect the market significantly. All right, so just focus on high impact events with strong historical reactions. All right. If the market reaction is unclear, just stay out. Okay. And that is how you master event driven trading. Now, key takeaways for you: first, follow economic calendars to track major events. Secondly, compare actual data to market expectations. Compare the actual values to the forecast. All right, compare actual data to market expectations and react to price movements quickly and manage your risks effectively. Now, event driven trading can be one of the most exciting ways to trade, but it requires preparation and strong decision making. If you enjoyed this breakdown, hit that like button and subscribe for more expert trading insights. Drop a comment below. What is your favorite event to trade? Thank you for watching, and I'll see you in the next one.